You know what nobody tells you when you finally save $10,000? They tell you to save it. They tell you to protect it. They tell you not to do anything stupid with it. But nobody, not one person, sits you down and says, okay, you have $10,000 now. Here is exactly what happens next. Here is the decision that is actually in front of you. Here is why this moment matters more than the moment you saved the first dollar. And because nobody says that, most people do the only thing that feels safe. They leave it where it is. They tell themselves they are being responsible. And then a year passes and another one. And the 10,000 is still sitting there, still in the same account, still doing basically nothing. And they still feel responsible about it. My name is Ronnie and I am 22 years old. I know personal finance channels are usually run by people in their 30s or 40s talking about what they wish they had done earlier. I am doing this from the earlier. I am in it right now, making these decisions alongside you, watching the people around me figure this out in real time. If that is the kind of perspective you are looking for, subscribe and hit the thumbs up, because today we are going to talk about why $10,000 hits completely differently when you are in your 20s and what that difference actually means for what you should do with it. Now, before I get into this, I want to tell you about my friend. He is 24 years old, same age range as most of you watching this. He works, he is disciplined, he made real sacrifices to get where he is financially, and about 8 months ago, he crossed $10,000 in savings for the first time in his life. I remember when he told me. We were just sitting around and he mentioned it almost casually, like it was not a big deal, but you could tell it was. You could tell he had been waiting to say it, and I asked him what he was going to do with it, and he said something that I have been thinking about ever since. He said he was not sure yet. He said he wanted to wait until he knew the right move, and then he said something I hear constantly from people his age. He said, at least it is safe in the bank. At least I am not losing it. Which sounds responsible until you realize that a savings account paying 0.5% while inflation runs at 4% is not keeping your money safe. It is just losing it more slowly and more quietly than any investment ever could. 8 months later, the 10,000 is still sitting in his bank account. Same bank, earning somewhere around 0.5% interest while inflation runs at 3 to 4% per year. He is not irresponsible. He is not lazy. He made the money through genuine discipline and real work. But he is doing the one thing that quietly costs you more than almost any financial mistake you can make at 24. He is waiting, and he is calling it being safe. And here's the thing I want you to understand before anything else. Waiting has a price. It is not a neutral decision. Every month that money sits doing nothing is a month of compound growth that you will never get back. Not next year, not when you figure out the right move, not ever. Time in the market is the one resource in personal finance that cannot be recovered once it is gone, and at 24, you have more of it than you will ever have again. That is not motivational language, that is just arithmetic. Here's what I mean. If my friend takes that $10,000 today and invests it in a simple index fund earning 8% annually, by the time he is 64, he will have $217,000 from that single decision. He does not have to add another cent. He does not have to make another move. Just that one decision made today produces $217,000 over 40 years. But here is where the 20-something advantage becomes almost unfair. If he waits 5 more years to make that same decision, the result drops to $148,000. Same $10,000, same 8% return, just 5 years later. The difference is $69,000 that evaporated because he was waiting to feel ready. And if he waits 10 years, which is not unrealistic, given that he has already been waiting 8 months and has not moved, the result drops to just over $100,000. $117,000 disappeared from his financial future, not because he made a bad investment, not because the market crashed, not because anything went wrong, just because he waited. This is the thing about being in your 20s that nobody explains clearly enough. The advantage is not that you have more energy or more hustle or more time to figure things out. The advantage is purely mathematical. Every year of compound growth you capture in your 20s is worth more than any year you capture later. Your 20s are not the time to figure out your financial life. They are the time when figuring it out costs you the least and pays you the most. My friend knows this. I have told him this. The math is not complicated, and he is not a person who struggles with numbers. but knowing something and acting on it are two completely different problems, and the gap between them is where most people's financial futures quietly disappear. So why do people wait? And I want to be honest about this, because I think most financial content skips over it. It is not ignorance. Most people who have saved $10,000 have enough financial awareness to know they should be doing something with it. It is something else entirely. It is a combination of three things that hit at exactly the same time and create a kind of paralysis that feels, from the inside, like patience. The first thing is the comfort of having it. When you have $10,000 in savings, for maybe the first time in your life, you feel financially safe. The last video talked about what changes at 5,000. That breathing room, that quiet alarm that finally goes off. 10,000 doubles that feeling, and the fear of losing that feeling is real. Not dramatic, not irrational, just real. The money represents security, and the idea of moving it somewhere that could go down feels like voluntarily walking away from the only security you have. So you keep it in the bank. Because the bank feels safe. Because nothing dramatic happens when it is in the bank. Because safe and stagnant look almost identical from the outside. The second thing is the noise. The amount of conflicting information available to someone who has $10,000 and is trying to decide what to do with it is genuinely overwhelming. Index funds, individual stocks, crypto, real estate, Roth IRA, regular brokerage account. Your uncle has one opinion. Someone online has the opposite opinion. A finance influencer is telling you that the only real move is something you have never heard of. And in the middle of all that noise, waiting starts to feel like the responsible choice. Like you are being careful rather than paralyzed. Like you are doing research rather than avoiding a decision. The third thing is the weight of the number itself. $10,000 feels significant. It feels like a decision that deserves serious research and careful thought. And that feeling is not wrong. It is just misapplied. Because the research has already been done. Thousands of academic studies, decades of market data, the entire history of index fund investing points in one clear direction. The information is not missing. The willingness to act on it is what is missing. And the longer you wait for more certainty before acting, the more of your advantage you trade away for a feeling of readiness that never quite arrives. Now here's why this hits differently at 24 than it does at 34. And this is the part I want you to actually sit with, because most people hear it and nod and then go back to waiting anyway. At 34, waiting one more year before investing $10,000 costs you roughly $33,000 in potential future value by retirement. That is real. That is painful. But at 34, you also have a career that is more established, income that is likely higher, and the financial decisions you make are more visible to you in terms of their immediate impact. At 24, waiting one more year cost you $60,000 in potential future value by retirement. The same year, the same inaction. $60,000 versus $33,000. Your inaction is worth almost twice as much at 24 as it is at 34. Not because you are more capable or more disciplined, because the math of compound interest rewards time above everything else, and you have more of it. This is the part that I think most people in their 20s genuinely do not feel in a real way. They understand it intellectually. They could explain compound interest to you if you asked, but they do not feel the actual weight of what a year means at 24 versus what it means at 34. And because they do not feel it, they treat waiting as a low-cost option. It is not. At 24, waiting is one of the most expensive financial decisions you can make. It just does not look expensive because the cost shows up 40 years from now instead of tomorrow. Let me show you the full picture of what I mean. Take two people, both save $10,000. Both are 24 years old. Both invest in the same simple index fund, earning the same 8% annual return. Person A invests the $10,000 today and never adds another dollar, just lets it sit for 40 years. By 64, they have $217,000 from that single initial decision. Person B waits, not forever, just until they feel ready, just until the information feels clearer and the decision feels more certain. They wait 3 years until they are 27, and then they make the exact same investment. Same amount, same fund, same return. By 64, person B has $172,000. The difference is $45,000. Gone, not lost in a bad investment. Not spent on something. Just gone because person B was 27 instead of 24 when they made an identical decision. And here's the part that gets me every time I think about it. Person B is not a bad investor. Person B made a perfectly reasonable investment at 27 and let it grow for 37 years. By any normal measure, that is responsible financial behavior. But compared to person A, they are $45,000 poorer at retirement for doing nothing wrong, just for waiting 3 years at the wrong time. My friend has been waiting 8 months. He has already given up a meaningful slice of his future, not because anything went wrong, just because waiting felt like the safe choice and the bank felt like the responsible place. And every month he continues to wait, the cost compounds in the wrong direction, while he calls it being careful. Now I want to talk about what he should actually do. And I want to be specific here because vague advice is not useful when you are standing in front of a real decision with real money. The first thing is to separate the 10,000 into what it actually is rather than treating it as one pile with one decision. Most of that 10,000 is probably already serving as an emergency fund. 3 to 6 months of living expenses sitting somewhere accessible. That part stays. It is not investable money. It is a financial immune system, and it needs to stay liquid and reachable. But it should not be in a regular savings account earning 0.5%. It should be in a high-yield savings account earning 3 to 4%. Same accessibility, same safety, just actually keeping pace with inflation instead of falling behind it every single month. Whatever sits above that emergency fund target, the money that is genuinely available beyond what you need for security, that money has a job to do. And its job is not to sit in a bank account earning 0.5% while inflation eats through it. Its job is to compound. The second thing is to open a Roth IRA if you do not already have one. For someone in their 20s, this is the single most powerful account available, and most people in their early 20s have never heard of it or keep meaning to open one and have not gotten around to it. Here is the short version of what it is. You contribute money you have already paid taxes on, it grows completely tax-free for decades, and when you withdraw in retirement, you owe nothing. The government gets no share of 40 years of compound growth. Zero. At your income level right now, before your career is at its peak, you are probably in a lower tax bracket than you will ever be again. Contributing to a Roth IRA now means you are locking in that lower rate on money that will grow for 40 years. On a long timeline, the difference between a Roth IRA and a regular taxable account can be hundreds of thousands of dollars. Not from better investments, just from the structure of the account. The third thing, and this is the one that removes the paralysis my friend has been sitting in for 8 months, is to start with one fund, not a portfolio, not a diversified strategy with multiple positions in a complicated rebalancing schedule. One fund, a total market index fund or an S&P 500 index fund from a provider like Fidelity or Vanguard. You are not trying to beat the market. You are not trying to find the best opportunity. You are not trying to time anything. You are trying to capture the market return over a very long period of time, which historically has averaged around 8 to 10% annually. One boring fund, held for 40 years inside a Roth IRA, is the foundation that everything else gets built on. The sophistication can come later. The complexity can come later. The optimization can come later. The foundation needs to come first. And the foundation is simpler than the noise around it would ever let you believe. Now I want to address something directly because I know it is sitting in the back of your mind while I am saying all of this. What if the market goes down right after I invest? What if I put in $10,000 and next month it is worth $8,000? What if I am the person who invests at exactly the wrong moment? This is the fear that keeps most people waiting. And I want to be honest about it rather than just telling you the market always goes up over time, which is true, but does not actually help when you are looking at a potential loss of real money you worked hard to save. Here is what is actually true. Over any 30-year period in recorded market history, the S&P 500 has ended higher than it started. Not every year, not every 5 years without interruption, but over 30 years, it has always recovered and exceeded every previous high. If you are 24 and you invest today, you have 40 years. You are not betting on what happens next month. You are betting on what happens over 4 decades. And over 4 decades, the historical record is not ambiguous. The question is not whether the market will go down at some point in the next 40 years. It will, multiple times. The question is whether you will be invested when it recovers. And the only way to be invested when it recovers is to be invested before it goes down. My friend is not waiting because he thinks the market is going to crash. He is waiting because the bank feels familiar. and $10,000 feels like too much to risk on something unfamiliar. And I understand that completely. But the bank is not neutral. The bank is a slow, quiet, invisible loss that feels like safety, and the market is a bumpy, sometimes uncomfortable, occasionally alarming path to a destination that the bank can never reach. I am 22 years old and I am figuring this out at the same time as you. I do not have 40 years of hindsight to draw from. What I have is the math, the historical record, and the experience of watching the people immediately around me make decisions that will compound forward in ways they cannot fully see right now. My friend is a good person with real discipline and a genuinely solid financial foundation, but right now he is letting the bank convince him that safe and smart are the same thing. They are not. And the cost of confusing them at 24 is a number that most people never calculate because it only becomes visible 40 years later. Your $10,000 does not look impressive right now. It does not change what your life looks like from the outside. Your friends probably do not know you have it. You cannot see what it becomes from where you are standing, but the math can see it. And the math says that the decision you make with it in your 20s is worth more than almost any decision you will make with money for the rest of your life. Not because $10,000 is a large amount, but because 40 years of compound growth applied to $10,000 is a very large amount, and the only way to get 40 years is to start at 24. Do not wait until you feel ready. Readiness is not a financial strategy. It is just a more comfortable way to let the bank win. If this reframed something for you, subscribe and share this with one person you know who has $10,000 sitting in a savings account right now, waiting for the right moment. Because the right moment is the moment you have it, not the moment the market feels calm, not the moment you have done enough research, not the moment your uncle stops telling you to wait, the moment you have it. And if you want to know exactly where to open that Roth IRA, which fund to pick first, and what the actual steps look like from the moment you decide to start, that is the next video. I will see you there.